The topic for today is the expense ratio in relation to mutual funds. When we study mutual funds, there are very important concepts, and out of them, one is expense ratio. See, when we invest in mutual funds, what does the mutual fund charge from you? Is there a charge to invest in mutual funds? The answer is expense ratio. So basically, expense ratio is the cost which you are paying to invest in the mutual funds. We will be discussing it at length today. Expense ratio is charged annually. Okay, you don't have to pay it every now and then. Once a while, annual charge is being made. See, there is a very well-known saying that there is no free lunch. It holds true in investing for mutual funds as well. When we go to avail the service of a doctor when we fall sick, or you take the service of an architect, in either way you have to pay the consultation fees. Similarly, mutual funds also charge a fee from the investors for managing their money. So when we invest in mutual funds, the fees which we are paying, which the investor is paying to the mutual fund to manage their money, and of course they are going to provide you certain services also, like providing you with the statements. So for all those costs, what you are incurring is the expense ratio. The expense ratio is not unique to mutual funds. For everywhere you go, for every service you avail, you have to pay a fee. Just as I told you in the case of a doctor and architect. Each and every financial product also that we purchase, let it be a simple fixed deposit or an insurance plan or a stock market investing, somebody is providing you with a service and they are also charging us for that particular service. When we invest money in a simple fixed deposit for a bank or in some insurance plan, for all these services there are hidden charges which we are paying. We may be aware of paying those charges or we may not be aware. The case may be different from person to person, but the truth of the statement is that we are paying for that service, and that stands true for investing in mutual funds as well. When we invest in mutual funds, we outsource money management. You have heard the word outsourcing of business these days. Similarly, here outsource of money management. We are entrusting a fund manager from a mutual fund company to manage our funds for us. The ownership of the money lies with us, no doubt, but the fund management is entrusted to somebody else. Now, the fund manager and the AMC, they are rendering a service to the investors, and for this service, they will be charging the expense which is called the expense ratio. The asset management companies, they are doing work for you and they will charge from you. Across the globe, people want the value for money. They want good services. They want astute fund management. Astute fund management money. They want the best for their funds to be get managed. They want handsome returns at the lowest possible cost. So when you invest in, say, fixed deposit, what do you want? You want the best of interest rate should be given to you. Your money should be safe. Okay, and at the time you also want that the interest should increase if there is fluctuating rate. Similarly, in mutual funds also, people want that their funds should be managed well and their returns should be the maximum, but the cost should be the lowest. It is a competitive free market, and this is how it is supposed to work. Each business will compete with other business on quality and cost. So the mutual funds are no different from this competitive world. Now, this involves the fund management fee, agent commissions, registrar fee, and selling and promoting expenses. So the total expense ratio which we are discussing today, which involves all these expenses mentioned right here. All these expenses, they fall in a single basket called the total expense ratio, TER, also called annual recurring expenses, as we discussed that they are being charged annually. Now, total expense ratio is expressed as a percentage of the fund's average weekly net assets. It is expressed, we will be discussing it in the slides to follow, that they are expressed as a percentage of the fund. See, if the expense ratio is 1% and you have invested 1 lakh, this means that you are paying 1000 for expense ratio to the mutual fund annually. 1% you will be paying, because 1% of 1 lakh is giving you this much amount. This you have to pay. You do not have to pay ER separately. There will be no separate column for the cost of expense ratio. ER, expense ratio, is deducted while calculating the NAV, net asset value. When you will be calculating the net asset value, this ER will be deducted already from that and net NAV will be shown to you. So, ER you are paying, but you are not paying it under a separate head. Okay. Now, you know that all the shares have their own particular price. Every share is at a price. Likewise, mutual funds also have what? NAV. We don't say the price, we say the net asset value of the mutual fund. Now, if you buy a mutual fund at rupees 10 NAV and now the NAV rises to rupees 15, then your return is 50%. When I say 50%, this is calculated after deducting expense ratio. So nobody will be explicitly saying you that this is the return and this is the ER. No, ER will already be deducted from your return and then this return will be shown to you. The NAV of mutual fund is published daily. What I want to insist is this NAV is calculated after deducting the expense ratio charges. Now see, if ER is 1% and you have invested amount rupees 1 lakh, see 1 year has 365 days. So for 1 day ER 1 day, it will be 1% divided by 365 days. Because this 1% is the annual charge, and when you divide it by 365 days, you will get expense ratio for one particular day. Now let us say that the investment rises from 1 lakh to 1 lakh 100 rupees. In this case, the daily ER will be 1% upon 365 multiplied by 1 lakh 100 rupees, which is rupees 2.74 paise. Now the next day, the investment rises from 1 lakh 100 rupees to 1 lakh 500 rupees. Now again you will calculate the expense ratio. This will be 1% divided by 365 multiplied by 1 lakh 500 rupees, which will give you rupees 2.75 paise. So daily the expense ratio will be getting deducted. And I have shown you how it will be getting deducted and what will be the base. Here the investment rises to this price, then the ER will be calculated on this point. Now when the investment rises to another high or low, whatever, then the ER will be calculated on the present rate of investment. So daily the ER will be getting deducted. Now, in order to check the expense ratio of any particular fund, you can see it on the fact sheet or the mutual fund website, and you can also see it at the valueresearchonline.com. Now, there are a list of many items which go in the expense ratio. First is the fund management fee, which includes the salary to the fund managers and their team. This is the biggest chunk of the expense ratio. Second comes the servicing, providing investor the services like account statements, documentation, etc. In the first slide, I told you that the mutual fund provides you statement. Which type of statements? The account statements, the documentation, and they all fall under the investor services. There comes the brokerage expenses, costs incurred to conduct trade in the portfolios, the service which we consume as the investors. Now we are consuming that service, so we will be paying, right? So this is the sum total of the lists which go and fall in the expense ratio basket. Then there is the register and transfer expenses. There are the custodial expenses, marketing expenses, business expenses, which include the rent and the infrastructure, and also the taxes. Okay. Now, total expense ratio is to be prominently disclosed on a daily basis under a separate head, total expense ratio of the mutual fund schemes, on the website of AMC and AMFI in downloadable separate sheet format. Now, what is this AMFI? This is the Association of Mutual Funds in India. See, the mutual fund is still a comparatively untapped financial sector. Initially, there was a lot of ambiguity and the myths around these mutual funds. People were basically reluctant to invest. Then the statutory bodies like the SEBI and the AMFI, they have played a massive role in keeping the investors informed. And now the scenario is a little changed. People are not that hesitant to invest in mutual funds. Now, any change in the base total expense ratio in comparison to the previous year's total expense ratio charged to any scheme or plan, it shall be communicated to the investors of the scheme or of that plan through a notice email or SMS or at least 3 working days prior to effecting such a change. So these are the guidelines which have been set forward by the regulatory bodies, that in case you want to change your total expense ratio, you have to very well inform to the investors of that particular scheme or of that particular fund, so that they know well in advance. Okay, it is not that you cannot hide this total expense ratio and then you can keep on increasing the fees of the expense ratio without informing the investors. This is not done. Now, expense ratio is a percentage of the total assets that are spent to run a mutual fund. Expense ratio is expressed in the form of a percentage, I have told you. So it is a percentage of the assets, expenses which are spent to run a mutual fund. Now, these expense ratio, it becomes a very important factor while comparing bond funds. How come? See, expense ratio states how much you pay a fund in percentage term every year to manage your money. Now, I have invested in different mutual funds and every mutual fund will be charging a different expense ratio from me. So that will be the percentage of how much I am paying to them so that they manage my money. A very important point I would like to say here, that a lower expense ratio does not necessarily mean that it is a better managed fund. A good fund is that delivers good return with minimal expenses. So please, I would like to repeat this line again, that if a fund is having a lower expense ratio, this does not guarantee that this is a better fund. No, there is no such rule. So the question is, what is a good fund? A good fund is that fund which gives you good return. In addition to this good return, it should have the minimal expenses. So the lower expense ratio is not a criteria to determine whether that fund is a good fund or a bad fund. Now let us understand what is expense ratio. Example, you invest 10,000 rupees in a fund. Allotment NAV is 10 per unit and the expense ratio is 1.5%. Okay, how much have you invested? 10,000 rupees. The NAV is 10 rupees per unit and expense ratio is 1.5%. In the first year of investment, the fund gains 10% and so the NAV jumps to 11 per unit, but this NAV is pre-expense. That means the total expenses are not deducted. Abhi, they are not deducted. Before deducting, the NAV is 11 rupees per unit. Now, after deducting the expenses, the NAV shall fall to 10.84. How come? 11 multiplied by 98.5. How do you get 98.5? 1.5 is the expense ratio. You minus from 100, you will get 98.5. So now after charging the expense, your NAV is 10.84. This delivers an absolute return of 8.35 to the investor. Got it? This is how we understand the expense ratio. NAVs are always reported net of fees, net of expenses. Therefore, it is necessary to know how much fund is deducting as expenses. You should be well aware that how much have they deducted. Since this is changed regularly, everyday basis pay, I explained you in the previous slide how you have to calculate it on a daily basis. A higher expense ratio over long term may eat into your returns massively. If there is a higher expense ratio, every year they will be charging. You have to pay every year for that higher expense ratio. So your returns will be affected massively through the power of compounding. It gets compounded, it gets accumulated. Now, every mutual funds come in two variants, regular and direct. When you go to a distributor who provides you the service and counsels you and guides you for an investment, and then there is one when you invest yourself. The difference between the two plans is that when you invest in the regular plan, the distributor gets paid a fraction of the expense ratio. He will be given his reimbursement for a fraction of expense ratio. And in the direct plan, because there is no distributor, you are investing yourself, that money does not get charged to expense ratio. So you can save if you are capable of making your own decisions and you have the ability to invest yourself, so you can save on this money. Now, how does the expense ratio has a big impact on returns? Now, it happens through the power of compounding. It works for returns as well. Unfortunately, as from the investor's point of view, the expenses can compound over time. The expenses will get accumulated every year. Every year you are paying the total expense ratio and they will be affecting your returns. Now, let us compare two mutual funds. They have the same gross return of 15% per annum. The difference in these two funds is that the first one has an expense ratio of 2.5% per annum and the second has an expense ratio of 0.1% per annum. So they vary in the expense ratio. One is charging you higher expense ratio 2.5 and the other is charging you very less 0.1. Now I will show you how these expense ratios have the impact on the long-term returns generated from investing 1 lakh. You are investing 1 lakh in each of these funds which have different expense ratios. Now see how the graph will look like. Your investment value is shown on the y-axis in the number of years on the x-axis after a period of 40 years. Why I have taken 40 years? Because I told you that the expenses, they get compounded. And when we invest in mutual funds, we do not do it for a period of 6 months or a year. Generally, it is considered that when you invest in mutual funds, it is for a period of say more than 10 to 15 years. If you want to go for a short-term investment of say 1 year, it's better you move in the fixed deposit. Now, as I told you in the previous slide that one is charging expense ratio of 0.1% and the other one is charging you higher expense ratio. So, your investment in one is going to be 2.6 crores after a period of 40 years. And after a period of 40 years, in the other one, the investment will be 1.1 crore. This one is charging you a lower expense ratio and this one is charging you a higher expense ratio. So, you can very well understand that how these higher expense ratio, they eat up your returns. They are eating up now because I told you that the rate of return is equivalent. The portfolio percentage is the same, but they only vary in the expense ratio. So every year expense ratio you will be paying to that extent that it gets accumulated, it gets compounded. And see the investment after 40 years, there is a substantial difference in the money. Are you getting it? Now the second fund corpus of the previous slide, the graph I told you, the investment exceeds the first fund by this much percent for the first 10 years, 20 years, 30 years. This is the data. You can compare it with the graph. Now a 20-year-old who invests 1 lakh when he or she starts working will get 1.11 crore when they retire at 60 years of age from the first fund, which had 2.5% expense ratio. Higher the expense ratio, lower is your return, and your return here is 1.11 crore. And from the second fund, which had the expense ratio of 0.1%, he will get 2.58 crore. This is more than double the corpus from the first fund. So this is how your expense ratio eats up on your returns. Please take the screenshot of the previous graph and the screenshot of this data and then compile it. Okay. Now, another example. Supposingly you have two funds. They have the same portfolio. See, this is very, very unlikely, but let us assume for the given example that the portfolio return is 12%. Now, this high portfolio return is also very unlikely in these days, but chalo, we have taken this example that they have the same portfolio return of 12%. Fund A charges again expense ratio 2% and fund B charges expense ratio 1%. So, abhi humne what did we see? We see that the portfolio return is the same, which is 12%, but the expense ratios are different, 2% in fund A and 1% in fund B. the return in the hand of the investor will be 10% for fund A. Now, how do you get 10%? The portfolio return is 12% and then you deduct the expense ratio of 2%. So, it is 10% for fund A and the return is 11% for fund B. How did you get this 11%? This is 12%, which is the portfolio return minus the ER percentage 1%. So, 11% is the return for fund B. Now, let me again assume that the amount of investment is 1 lakh each. What will happen? So this is the table which will show you that, see, for both the funds, fund A and fund B, the portfolio return is the same 12%. Okay. Now in the first year, the investment value is 1,10,000 and here investment value is 1,11,000 rupees. So this is the data pertaining to all the 5 years. Now see the difference after 5 years. How come? This is 1,61,051 rupees and here is 1,68,505 rupees. The difference in the returns add up substantially because mutual funds, they, as I told you, employed for a longer period of time, not for 1 year or 6 months. Clear? So what I want to say here is that if expense ratio is very high, 2% and expense ratio is 1%, 1% change in expense ratio is going to give you a substantial change, substantial difference in your returns after a period of 5 years. So what I want to infer from here is that expense ratio is a very important factor in eating up your returns. Very important factor in deciding the investment value of your fund after a period of 5 years or 10 years. Clear? Now, presently, most equity mutual funds have an annual management fee of 2.5%. In contrast, an exchange traded fund, the ETF, this annual management fee is approximately 0.1%. Now, different funds have different expense ratios, but the SEBI, Securities and Exchange Board of India, has stipulated a limit that a fund can charge. The upper limit is placed by the regulator. It is not left to the discretion of the companies that they can charge whatever they want. So, SEBI has fixed a limit for that expense ratio. Expense ratio is different for different category of funds, like equity fund it is different and debt fund it is different. Expense ratio decline as the fund grows. As the fund grows bigger and bigger, expense ratio gets smaller generally. The largest component of the expense ratio is the management and the advisory fees. From the management fee, an AMC generates profit. The asset management companies, they generate profit from this management fee. There are marketing promotion expenses. All those involved in the operation of a fund, like the custodian and auditors, also get a share of the pie. Interestingly, brokerage paid by a fund on the purchase and sale of securities is not reflected in the expense ratio. Funds state their buying and selling price after taking the transaction cost into the account. They will first consider their transaction cost and then the funds will tell their buying and selling price. Now, this is the slab for the costs. Like we have income tax slabs. Similarly, here is the slab. This is the asset under management slab. When it is from 0 to 500 crores, the TER, total expense ratio for the equity oriented schemes is 2.25% and for other schemes is 2%. And so for every slab, I have shown you the table. And when it is over 50,000 crores, it is 1.05 and 0.8 respectively. As I told you, as and when the slab gets higher, the investment gets higher, the expense ratio comes down. Okay. Now, recurring expenses which are charged directly to the scheme which affect the NAV. NAV is definitely affected by these. What are these? Marketing and selling expenses, including the distributor fee, brokerage charges. In case the AMC is not adjusting the brokerage charges in buying and selling price, then there is a registration fee, audit fee, custodian, all these expenses I have already explained it to you. But I have given you a separate list of the recurring expenses which are directly charged to NAV. Kindly make a list of this. Now, the expenses that are not charged to the scheme and hence they don't affect the NAV. That is why I made a separate slide. There are directly charged to the scheme and then there are not directly charged to the scheme. This comes These don't affect the NAV. They are penalties and fees for the violation of the law, the interest on the late payment to the unit holders, the legal, marketing, publication and general expenses not attributed to any scheme, and the depreciation on the fixed assets and software development expenses. Okay, now what is the importance of expense ratio? Let's restudy. Expense ratio matters especially in case of debt funds. When bond funds were giving a whooping 14.5% return, nobody cared about the expenses. Why? Because you were getting so high returns. But gone are the days of the double-digit returns. Nowadays, generally, you don't get so high returns, so you have to worry about your expenses. With an all-round reduction in the interest rates, the bond funds are expected just to give you 7 to 9%. Thus, in a low-yield universe, every penny will count. You have to consider every penny. As the expenses are deducted from the fund before calculating the NAV, I told you already, it is likely to be a major differentiating factor among bond funds where returns vary marginally because the bracket of the returns is from 7 to 9%. Okay. So when the returns are varying just marginally, they're almost the same. So expense ratio, they have very important weightage. You have to consider the expenses ratio before investing into any fund. Since mutual funds, they are employed for a longer period of time, the difference becomes substantial. I told you. If we choose a fund with a lower expense ratio, we may end up with a poor quality fund. So you cannot make expense ratio as the sole factor for deciding where should I invest. And you don't have to go and hunt for a fund with a lower expense ratio. I will find a fund with a lower expense ratio, the lowest expense ratio, and I will invest into it. It's a wrong decision. It is not a wise decision. In this case, if you choose this way, you may be losing out more on returns than we gained from a lower ER. Please consider this line. If you do this stupid decision that I will invest in the funds with a lower ER, you will be losing more on the returns. You will be penny wise and pound foolish. You don't have to be like this. You cannot use expense ratio alone as a determinant factor for choosing the funds. But it is imperative that they need to be a part of the decision-making process for choosing funds for investment. No doubt, the expense ratio is a very important factor for finding the investment plan. But this is not the only factor to make an investment plan. If you have to choose between two funds, both are of the same quality, same returns, then go for a fund with lower ER. First of all, you have to compare the quality of the fund. You have to compare the return of the fund and then please compare the expense ratio, but not always. First, you should compare the fund quality, the performance of the particular mutual fund. Please compare the risk and the reward factor and then comes the number of expense ratio. If you compare only and only expense ratio, you will land up in choosing a bad fund, which will not be a wise investment decision. Believe me. Now, in case of actively managed equity funds, the issue of expenses is more complicated. The wide divergence of returns between good and bad funds makes the expense ratio secondary because the returns is higher. But here too, if you find two similar funds, then expense ratio can be a good differentiator. Perhaps more important is the fact that the expenses are charged at all the times. Whether a fund generates positive returns or negative returns, the expense ratio will always be there. The service cost of mutual funds will always be there. Overall, before venturing into any fund, just check out this important number. Okay, that the expenses are charged at all the times. Now, the mechanism of expense ratio, the cost of financial products is either completely hidden or completely open. See, I told you that whenever you will be taking the service of any financial product, you will have to pay the service. When you invest in a fixed deposit, then this cost is hidden. When you go to a bank, okay, I have 1 lakh rupees and I want to make an FD. They will never say that, sir, this is your charge for making an FD. They will say, we don't charge. But there is a charge, there is an implicit charge which is not revealed to you. There is a hidden charge. Okay, so in FD, in case of banks, the charge is hidden. But if you invest in stock trading, the brokerage amount, this is not hidden. This is completely open. The banks don't disclose the cost in FD. They definitely make their profit, but still they make a profit out of it, right? It is hidden. In case of stock trading, you explicitly pay the brokerage. It is being charged from you and it is told from you that we are charging it and you happily pay it. Now, in case of mutual funds, it's a hybrid case. Both. There are expenses, but we do not know them explicitly. You do not know. We pay them implicitly. How you pay implicitly? Because your NAV is being shown after deducting the expenses. We know we are being charged, but we do not know clearly how much we are being charged. Hence, there's a little confusion on how the mechanism of ER takes place. That the principles that go behind the mechanism on the functioning of ER is that it should be equitable. Your money is treated in the same way as other investors' money in the scheme. So, if you are paying that expense ratio, which is equitably distributed among all the investors, among each and every investors, then it will not harm you. Then it will not hurt you because everybody is paying, so you will also pay. So, the first principle which I consider is that it should be equitably spread over all the investors. The charged amount should be proportionate to the period of your investment. Obviously, you are keeping the fund in that particular scheme for a longer period of time, then you will be paying more expense ratio. So, if it is proportional to the time of investment, it will not hurt you, and this is the basic principle. Then it should not be an explicit charge, let it be implicit only, right? Now, the ER of a particular fund may vary. Once shown ER will not remain the same, it can very well change. So today, if you are investing in a particular fund, it is not compulsory for that fund scheme to maintain the same ER over a period of years. It is their discretion. If you want to change, they can go ahead. But according to SEBI, if some scheme is raising the ER, it needs to inform its investors. You have to very well inform your investors. This is the condition put forward by the Securities and Exchange Board of India. Now here I come to the end of the article. I hope I have made the things very clear to you. If you have any doubt, please feel free to ask in the comment section. Please like and subscribe to my channel. Thank you for watching. Stay safe, stay blessed.